When a market participant dumps the amount of gold and silver on the market that they did in the middle of the night when no one is awake and no one is trading and there's virtually no liquidity, it is done specifically for effect. But when you see Jeffrey Gundlach, the bond king, Michael Hartnett, the high-paid, highfalutin, big-time analyst at Bank of America with his $10,000 a year plus whatever it is, newsletter, very expensive, or the CIO at Morgan Stanley, or the chief financial officer at Jefferies, or Goldman Sachs saying if the Fed loses independence, you'll see $5,000 gold right away. Well, but I think, look, you're still much higher than you were just a few weeks ago, even with the pullback, or a few months ago. So pullbacks are healthy. They need to happen.
Andy Schectman, a longtime precious metals analyst and industry insider, recently addressed the suspicious market behavior often seen during thinly traded hours. He pointed out that when massive amounts of gold and silver are suddenly sold in the middle of the night, when global liquidity is at its lowest, it's not a coincidence. It's done deliberately to influence sentiment. Yet, despite these artificial moves, the broader picture remains strong. Prominent voices across finance, from major banks to top fund managers, are now openly discussing the possibility of a $5,000 gold price if the Federal Reserve loses credibility or independence. Even with short-term volatility, prices are still much higher than just weeks ago, and healthy pullbacks often reset the stage for the next rally. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
We have to use a little bit of supposition to connect those dots. And that's why I'm always fast to say, I don't know, but things reek of desperation. And again, I know I've said it 12 times tonight, but when a market participant dumps the amount of gold and silver on the market that they did in the middle of the night when no one is awake and no one is trading, and there's virtually no liquidity, it is done specifically for effect. And it is not done to maximize the return on said trade. And if this was your account and they did it for you, you would literally be at their door in the morning with a pitchfork. And that's why you have to take a step back and say, yeah, all of the reasoning that people are afraid about, could it be the peak like in 2011? Could this go on forever? All of these things to me have far less significance when we see the lengths at which they're going, and then to see it come back and turn around the way that silver did. Now, who's to say it's still not going to fall more? Maybe it will. But I think, look, you're still much higher than you were just a few weeks ago, even with the pullback, or a few months ago. So pullbacks are healthy. They need to happen. And quite frankly, markets that move as fast as this one did are asking for a flush out of speculation and a profit taking. And there is legitimacy in all of that, just not the way that it went down. I would just simply say that in this environment, if you don't own assets, you're dead. You need to own assets. Whatever those assets are to you, you need to own them, because assets have been going up in the face of a falling dollar. To me, gold and silver are the preferred assets, not because I own a precious metals company, but because I see them as being reintegrated and have been blurred. Their true value have been blurred because of this Keynesian-based system for a long time. But when you see the most knowledgeable investors in the world, the central banks, as I've said, for 5 years, 6 years now, accumulating it at the pace they have, it tells a different story. When you see the deliveries into COMEX, which would be the most sophisticated institutional traders in the world doing this, and whoever is behind it, well, you got to stand up and take notice. But when you see Jeffrey Gundlach, the bond king, Michael Hartnett, the high-paid, highfalutin, big-time analyst at Bank of America with his $10,000 a year plus whatever it is, newsletter, very expensive, or the CIO at Morgan Stanley, or the chief financial officer at Jefferies, or Goldman Sachs saying if the Fed loses independence, you'll see $5,000 gold right away. Well, there is no independence with Stephen Mirren there now, and Bo Hines at Tether. I can keep Jamie Dimon saying for the first time in his career, owning some gold is a good idea. I mean, all of these things, none of them have ever happened, and I think they're giving you crumbs, whether you choose to follow the path and connect those crumbs, connect those dots into a linear progression of something bigger. That's your choice. I choose to see it as a warning sign that has little by little by little gotten bigger and bigger and bigger. And when I was talking to you about this 3-4 years ago, I don't know how many times, what has gold done since then? Doubled, tripled? Silver doubled, tripled? I don't know. I'm not sure. But all I can tell you is that the slow moving acceleration has gone unnoticed by the people in this country. And now all of a sudden they notice it because it's reached a high level. And they really notice it when it gets the snot pounded out of it, because you really didn't see too much other than tickers. Yeah, gold's going higher, gold's going higher. But you sure hear a lot about it when it gets hammered in the middle of the night and it's over and it's reached its peak, and move on, keep looking elsewhere. Yet at the same time, we're being told that the deliveries in the month of October could be the highest ever.
Andy Schectman reflected on the unusual overnight sell-offs in gold and silver, calling them acts of desperation rather than legitimate trades. He noted that no rational investor would dump massive volumes in the middle of the night when liquidity is almost non-existent. It's done purely for psychological impact. Despite these orchestrated moves, Schectman remains focused on the bigger picture. Gold and silver continue to outperform in a weakening dollar environment, with central banks and major institutions steadily accumulating. Even prominent financial figures now acknowledge gold's role as protection against systemic fragility. These warning signs, he argues, have been building for years, and the recent volatility only confirms their growing importance. Let's get into the interview.
Large quantities of silver are being transported out from exchange warehouses and sent to secondary silver vaults across the country, ensuring the daily silver needs of millions of industrial enterprises. At the same time, state-owned enterprises are taking advantage of the significant price pullback to actively purchase silver from international markets, ensuring the normal operation of the industrial system. China is intensifying reserves of various strategic resources and will absolutely not allow key mineral resources to flow out of the country, nor will ever compromise national interests to rescue a foreign company. Now, here's another thing. Eric Young, King Kong on Twitter, someone that I've been wanting to have you interview. I've interviewed him once before, and he's fantastic. He was just told, he says, I was just told that 150-ton lease, or 4.82 million ounces, actually was leased by the London Metals Exchange from the Shanghai metals market, and that it was done so at grotesquely high lease rates for a very large tonnage. This would signal that borrowers who are short of deliverable metal and are willing to pay up to bridge the near-term needs in London are doing it because things are of that dire of a situation where it could really start to spiral and contagion can take effect. So again, when you see someone at this level who's been right for a very long time, and I have nothing but the highest amount of respect for him. To me, the bottom line is that the theme that we've been talking about, the tight physical, the high lease rates, the cross-region scouring for bars, this is real and well reported. And if you see 150 million tons from Chinese state banks and via the Shanghai Gold Exchange delivered to London to quell this problem, it would go hand in hand with knocking the hell out of the price by the same players to make people think the market is overvalued, that it's at its peak like it was in 1980 and 2011. And look, letting the price go up as high as it did pulled in an awful lot of speculators, and a lot of them didn't own gold; they just owned paper. And so when you dump massive waves of futures contracts into this thinly traded market, a lot of them sold without even knowing. They got triggered out of their contracts, which drove the paper price down. And maybe that's when you had London come in and say, we need to buy this silver at a lower price. Maybe it was London who came in and bought that silver after they knocked it down. I don't know who did it and who bought it. But I do know is that, to me, the whole point was to scare people away from buying gold and silver. That's what it really feels like to me. And this wasn't just another random correction. To me, it's as much as it could be as big as helping keep the LBMA propped up to maintain their system. But If there really is that much of a shortage that we've been hearing about forever, this game can't last, and supplies will keep shrinking no matter what amount of paper selling comes into the market at inopportune hours. And so I think, again, yes, it's scary to see a market move like this, but the fact that it moved like this is what, to me, makes it not so scary. It just reeks of desperation by big players who have been caught in a game where no one ever stood for delivery, and a continual rotation of paper promises has been what has allowed the fixing of gold and silver by the West forever. And it is now being challenged. Not just gold and silver, all of the world's commodities are being bought. And when we see 21 days of backwardation, where the normal market is called contango, where the price is for the future, or the spot contract is lower than the futures contract. When you go out into time, you have the cost of storage and interest and the time value cost of money. That's normal market. Backwardation says, I don't really want to trust you next month or the month after. I want it now, and I'm actually going to pay more for it right here today than I will out into the future, because I really don't trust the future. And to see that in silver is really unusual. And for as long as we did, and as much as $3, now it's narrowed. But what I'm saying is that is really very bullish. And when you see this kind of desperation knock the hell out of the price and then gobble silver up to where it goes green in 20 minutes, someone came in and bought physical. And maybe that was the trade. Maybe what Eric Young is saying happened right then and there, that China leased the gold at that level, sold the gold to London to bridge the gap at a huge rate of borrowing. I don't know, but all I can tell you is that it is not what one would expect to see in a normal market behavior, not even close to it, unless you want to be guaranteed the worst possible settlement for your huge trade that you dump just like that at the worst possible time. You're watching massive stress in London. There are reports that there's genuine stress for silver, lack of silver in China, that the supply chain has completely been dried. For the first time in 50 plus years, central banks not only are buying gold, they're buying silver too. We saw Saudi central bank purchase almost 30 million worth of SLV in August. As much as I almost choke on saying that, SLV, the amount that they bought would allow them to take possession. And then you get reports that foreign investors now hold a higher amount of gold than U.S. treasuries. In fact, the share of U.S. treasuries, they were saying, was down by foreign investors from 49% to 31% today, 49% in 2013 or 2012, somewhere in that neighborhood. But in other words, at the same time all of this stuff is happening, you're beginning to see real stress within the banking system, where we've seen these two big the auto supply and the other company, I think it was called Tricolor subprime auto lender, and the private equity in dealing with subprime auto lenders. This company just went belly up and is tied to the regional banks. And you got Jamie Dimon, who comes out and says, this is like a cockroach, where you find one, there's lots more of them. You have the head of the IMF, Kristalina Georgieva, I think is her name. She said this keeps her up at night. And then you see the banks in the repo market. All of a sudden, you have a repo market where you're seeing banks starting to pledge, instead of treasuries, they're pledging their toxic assets like mortgage-backed securities, because the banks are stressing because of all the problems in the commercial real estate market. The banks are in trouble again, and you can see that by looking at the repo market, what's happening. So you have all of these things happening at the same time. Government shutdown, stress with the regional banks, private equity starting to fail, which puts more stress on the banks, on top of all of the things that we've talked about. And I think gold up for 9 straight weeks, I think, was starting to perhaps make some of the people, these large banks who hold these large positions, very nervous.
Andy Schectman closed his remarks with a sobering reflection on what appears to be deep systemic stress across both the metals and banking systems. Massive silver outflows from exchanges, record lease rates, and backwardation in silver all point to an extraordinary level of strain beneath the surface. China's stockpiling of strategic resources, London's scramble for supply, and the unusual coordination of paper market sell-offs suggest desperation, not stability. Meanwhile, global banks face growing liquidity concerns, and central banks, and for the first time in decades, are buying not just gold, but also silver. These are not random events. They're signals of a system under pressure and a world rapidly losing trust in fiat promises. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.